Welcome back to COGEX 2020 Fintech Stage. We're live today, last session of the day. Last but not least, I would say, if you're just tuning in, we've had a really fascinating 2 days. I recommend watching back, where we look really at so many different emerging trends. I'll go on to when I sum up after this talk, but I think we've really had an idea of how financial services is changing, in some ways slowly, some ways quickly, and we couldn't not do SPACs. Obviously, booming year for IPOs last year. We even had IPOs happening in August, and also a surge in SPACs. Some people know exactly what they are, some people might not, but I'll leave you in the capable hands of Mario Gabriele, who from the Generalist, who is very well versed in SPACs, and has two excellent guests to discuss everything. So perfect way to end the day. Thank you, Mario, for joining us.
It's my pleasure. Thanks for having me. And I'm glad to introduce my two guests who definitely know much more about SPACs than I do. I have the pleasure of studying them, but have not gone through the process. So I'm excited to introduce Matt Ehrlichman, CEO of Porch Group, and Amy Butte, who is a principal at IronSpark. Hey to both of you.
Hello.
Hi.
All right. Well, from what we've heard, we are keeping most of you who are there in person from the bar and, more connections. So we'll try and keep this upbeat and relatively lively. Please do ask questions and we'll make sure to leave time for that. The point of today really, I think, is to, one, get a better grip on what SPACs are, two, sort of understand what the trade-offs are like for, both investors and founders, and three, sort of look ahead to get a sense for where SPACs might go in the future. And so to kick things off, I will pass it over to Amy to give an introduction, and maybe you can sort of tell us why this is a topic that you care about and have spent time thinking about.
Thanks, Mario. Well, I have taken companies public in multiple ways. I've taken them public as a banker, as a research analyst, twice as a CFO, including being the CFO of the New York Stock Exchange when it went private to public. I've been a director of a SPAC going through its own process of completing a transaction, and also a director of companies that have gone public a traditional way. I believe that there is a space for SPACs, and we'll talk about that later. I do believe that there will be innovation in the future as it gets there. Most recently, our IronSpark 1 went public last week. I'm limited in what I can say because we're technically still in a quiet period, but it is a warrantless SPAC, and it is paying a quarterly dividend, which is new, and I believe a good example of innovation to come in the world of SPACs.
Awesome. Matt, would love to hear sort of the same from you.
So it's good to be here with you all. I'm the founder and CEO of Porch Group. I've actually, kind of seen it all in terms of the different paths that a company could take. I've been a technology entrepreneur along the way, had bootstrapped my first software as a services company out of Stanford, and grown it and had a nice sale, and then was an executive of the second company that took it public through the New York Stock Exchange through a traditional IPO. And then I wanted to go build one more company, which is Porch, and founded this company 8 or 9 years ago. We launched 7.5 years ago, and have had a really good run. I've built good scale. While we had not probably initially intended to go public through a SPAC, a year plus ago, that's the path that we decided to take, and went public, through a SPAC merger in December of last year. And so we've been public now for around 6 months. Happy to share some of the stories and the learnings along the way.
Yeah, I think that's actually sort of maybe the best place to start is, Matt, I would love to hear more about what Porch does, the space you're in, and how that sort of discussion first started around potentially going public via a SPAC.
So Porch Group is a vertical software company in the home services space. So we provide back-end ERP and CRM software to a wide variety of home services companies. We've gone very deep in the home inspection industry, for example. 28% of all home inspections that happen in the US actually are managed through the software that we provide to home inspectors. And so we work across with moving companies and roofing companies, a number of other verticals to help these small businesses scale and grow and run a modern business. What is unique about Porch is, yes, those companies pay us with typical SaaS fees, but we also have created an ability to help those companies provide a better moving experience and home ownership experience for their customers. And so those companies, in part as a way they pay for our software, introduce us to their customers, and we then help those customers get insurance set up for their new home, or get the mover coordinated, or be able to get TV and internet set up, and make this journey that people have as they're moving into a new home very easy. And so in particular, in insurance, we are one of the largest insurtech companies that's built this large insurance platform on top of our software system, because we get access to so many of the US home buyers very early who are required to get insurance for that new home. And that's part of what we've built. Happy to talk about the SPAC, why SPAC as well, maybe for a moment. A year and a half ago, company was certainly doing well. We knew we wanted to be able to go and take the company public. At that point in time, we had planned on a traditional IPO, and we were looking at late 2021. But we were approached by a SPAC, and through a number of conversations, just got educated in terms of the pros and the cons that we can talk more about. And so it was a little more than a year ago, we decided, okay, yep, this makes sense. And really the reason that we moved forward with a SPAC was time. We were able to get public a full year earlier. And for us, that made a lot of sense in terms of the math to offset any incremental dilution, because it capitalized us faster, got us public faster, so we can go do some really, some meaningful acquisitions that we executed in the first quarter and second quarter of this year. And so that's why we ended up pursuing that path.
Got it. I think Matt has hinted at sort of one of the big pros of SPACs, which is speed. Amy, just for folks getting up to speed here, how would you sort of describe maybe the basic architecture here and the sort of traditional pros and cons that a founder might weigh up?
Sure. If you don't mind, I'm just going to step back a little. I'm assuming that we have lots of fellow students of financial services, in the house. And that's really what I think about myself as. And so if I step back and say, why are they here? What purpose do they serve? And hence the reason why I believe they will continue into the future. If you go back to the early 2000s, capital raised by companies going public or capital raised by late stage VC or taking late stage VC was only about a 5% of the overall market of funds raised. If you look at IPO, SPAC, late stage VC. If you go to about 2 years ago, late stage VC represented close to 40% of all the capital raised. And that was really disintermediated by SPACs last year when it hit 20%. So you had a swap. And so what I believe is happening is expensive late stage VC is being disintermediated by SPACs. There's room for all three: traditional IPO, going public through SPACs, and late stage VC. But I do think the fact that more people want to give money to fast growing companies like Porch Group, but it's so expensive, is showing entrepreneurs and leaders of companies why there is an alternative to the public markets than the traditional way. I am a believer in the public markets. I guess you wouldn't be CFO of the New York Stock Exchange if you didn't believe in the public markets. And you think about the value proposition of going public. There's a marketing component. There's an employee retention and compensation component. There's having a public currency component, depending where you are in your life cycle or how quickly you want to get to market. A SPAC can be attractive for that as well. And also just access to less expensive capital. So I'm a believer in going to the public markets, and I'm also a believer that disintermediating late stage VC is probably a good thing for high growth companies that we want to see in the capital market. So one, I think that's the context that I bring. In terms of the structures, I would like to think that there's the traditional SPAC and then what I will call the SPAC 2.0 of where we're going onward. Traditionally, what a SPAC has a sponsor group that for a small amount of equity takes on 20% ownership of the SPAC. They are charged for a different amount of time, usually 24 months, to go out and find a target and merge with that target and take it to market. I would say that the interest in targets, what you can ask the question, why have electric vehicle or space companies been interesting targets for SPACs? The real reason, beyond their interest in getting to market for all those reasons I mentioned before, is that when you do a deal with a SPAC, you're filing an S3 in the United States versus an S1. An S1 is the document that you use to go through a traditional IPO process, and you can't have forward-looking statements in there, right? That's why in a traditional process, you depend on investment banks and analysts to communicate what they think the projections will be. In an S3, you can talk about projections because it's a merger. It's technically a merger between the public entity and the private entity. It's just that the private entity will take over in terms of management and usually control, and all of these other things that you negotiate. But that's why high growth companies are really interested in going to market through SPACs, because they can talk about their growth in a way they can't through a traditional IPO.
Matt, does that feel like that was a big part of your story with Porch?
Yeah, I think that's exactly right. I think that there are a number of pros and cons, on both sides. I think that being able to share projections is an important advantage that a SPAC has. I think the fact that you can go and actually test the market quietly, through a pipe before and really understanding how the market is going to react, to your company before being fully committed and fully public is a big advantage. That's an important part of the process. Certainly, I think that the ability to build in a number of different components to get a deal done, like an earnout or a management incentive. There's a number of different levers that you have to be able to make that transaction work for all parties involved. The company, the SPAC, and the investors, the PIPE investors, and the future public investors. And so there's just more tools in the toolkit, and that's all on the pro side. But on the cons, there are some things that are harder. You don't have as much built-in analyst support, or at least maybe it's trending to improve, but Porch was out ahead of this this massive wave. We didn't realize there was going to be this huge wave of SPACs that would come behind us, and the volatility that came along with that. But for us, that was something I would do differently, right? Is to be able to make sure that we had sufficient analyst and sell side coverage, built in. That certainly was harder. The warrants, now obviously some are innovating here and approaching it differently, but most, you're saddled with certain warrants, and it's fairly complex, and there's been accounting changes, and that's created complexity for a number of SPACs. So some pros and cons certainly, but obviously for us, the speed in particular, and the ability to then go and just have exactly like was discussed here, the capital and the lower cost of capital that allows us to be able to just grow the business faster, outweighed any of that incremental dilution, and it was the right play for us.
So to be fair, Matt, none of us expected the volatility that has come in the last few months. And if I could, I'm sure people already know this, but once again, in the US, when you go public through an S1, you can do what's called testing the water meetings. So you can go out and speak to investors before you actually make it public that you're going public. In the world of SPACs, usually what happens is the SPAC itself is not have enough capital as according to what the company wants or needs to grow at the rate it's projecting. And therefore you go out and raise a PIPE, which is a side-by-side investment vehicle where they're also buying at $10 a share. And that's another way of, if you will, testing the waters and making sure that there are large institutional investors and high quality investors interested in your deal. And if I could, I would add one more component to what will differentiate SPACs going forward. Beyond dilution in warrants or non-dilution if you don't have warrants, I think that it's also going to move from an era of financial engineers to operators, people that actually come with experience, either taking companies public as a CFO or as an operator of an organization, that they can bring value to the table, not just a banker's perspective to the table.
Well, I very much want to come back to something about Matt's process, but before that, just to jump in on that point, I'd love to know why you think like that will be sort of the profile of the person bringing these SPACs forward, when it feels like to date we've almost seen a play on the mimetic nature of markets with a lot of these SPACs. It's sort of celebrity driven a lot of the time, or financial celebrity driven, and certainly those that seem to catch the public attention, are attracting that sort of profile of person. Why might we see it shift towards someone who is maybe a little bit more tactical?
Well, I think the part of the biggest reason is it's getting more competitive, right? On average, there are about 250 companies that are public market ready per year, right? And right now, combination of SPACs in the US plus those are registered, I think we're over 500. So there are too many SPACs for targets. There are going to be fails in terms of SPACs that want to go public, and there are going to be fails in the de-SPAC. And that means that investors are going to have a lot more scrutiny over what they invest in. We definitely felt it, right? In terms of making sure that it's a management team that can bring value, that if you're a pipe investor, making sure it's a valuation they agree with. And I also think that regulators, and we'll get into this later, are going to have a little bit more scrutiny in terms of what they're permitting and how they're overseeing kind of the SPAC process. So quite simply, more competition means you have to bring more value to the table.
Yeah, and I would just double down on what Amy's saying. There are too many SPACs in my mind, and that will wash itself out, here. However, I do believe she's also right that there are not enough good SPACs, and so companies like ours, where you're performing well and doing well, we were way out in front of that. And so it wasn't, people weren't doing a big bake off at that point, but clearly now, companies are going to be very selective. And so as you are kind of evaluating who you want to be partnered with, because you're building a partnership, which is going to continue for a long period of time. That SPAC and those sponsors are important shareholders, are going to be on the board, are going to be involved. And so you want people that are going to add value at the end of the day and be able to help. I do think that the companies that are going public through a SPAC that are the most successful are the ones that aren't trying to grind every last dollar out of that upfront valuation, but are really trying to set it up such that it's successful for all parties in terms of where the valuation is and how it's formed. And so part of that means who you are partnered with, if they can add value, is going to help just build a better company over the long term. Because that's what this is all about, is building something for the long term. One small note on that. Some of the questions that I get the most from entrepreneurs, I think some do believe and have this mindset of, a SPAC is almost like a sale, of the company. And I couldn't stress strongly enough that it's not. It is just a mechanism to get the company public. It's just a financing, event. And when you go public, and you complete that SPAC merger, that is not the end. That's actually the beginning of the journey to now go and build a public company. And so it is really important, I think, to have fewer SPACs over time and just let the highest quality ones really stand out. I also think that it's important on the other side to have companies that just aren't ready to be public companies. Clearly also show that those didn't work and those failed, because we need to be more selective, I think, on both sides for it to be the most healthy kind of ecosystem.
Matt, you sound like you're at the long-term stock exchange having a conversation with us about that, which is really, that's, I think the onus is going to be on SPACs to show their commitment to long-term growth, not just a short-term transaction. So thank you for saying that.
Yeah.
So I think there are sort of two interesting things that I'd love to pull out there. One, which is we probably have too many SPACs and there are not enough companies available. So first question is really, what happens next? Like, do these SPACs start to look further afield outside of maybe US targets and, sort of do the Peter Thiel Bridgetown play where they're looking for companies in Southeast Asia and other geographies? Do they sort of make a Bill Ackman style play where they, technically sort of go through a SPAC with UMG, but realistically there's still a lot left over and, there's some other things happening there? So that's sort of question one that I'd love to tease out with you guys. And two is, Amy, you mentioned that there's something around like 250 companies a year that maybe are ready to hit the public markets. What percentage in a sort of steady state, mature SPAC market should be going through SPACs versus traditional IPOs? And so maybe we can start there.
We'll start there. So if I just go back to the percentage of, 5%, 95% in the early 2000s being late stage VC versus traditional IPO, and we probably, overcompensated for 40% SPACs, in 2020. My guess it's probably 20% SPACs, 20% late stage VC, and the remaining is traditional IPO. Because it's really, I know that when we were looking at the consumer space, we not only looked for an industry that wasn't, projecting so far ahead, but like real businesses, but we also thought a lot about not just how much late stage VC was going into the space. So if you look at kind of B, C, D and above, it was a very high percentage. It was about 40% of all late stage VC was going into consumer. And of that, a very high percentage was going into our focus space. So I do think you can be thoughtful, and it's probably more like 60, 20, 20.
My take is that and nobody knows, and we'll see how it all shakes out. I think it'll end up being a bit higher, in terms of SPACs, the percentage of companies going public through a SPAC, just because of the advantages. I think there are meaningful advantages, and speed being one of those. So I think companies, that are late stage and have interesting acquisition, targets in particular, a SPAC can be a mechanism that allows you to be able to go get public, take advantage of some of those scenarios. And so, but we'll see how it shakes out. Certainly it's gonna, there's gonna be fewer SPACs than there are today. And already, you see that starting to shake out again with some of the accounting changes and such, and the work the SEC is doing to try to moderate it and try to just have it become a healthy, ecosystem at the end of the day.
I'd be happy to be proven wrong, particularly in the next 24 months. I think I like to think about things through cycles and over time, and we do know that it's not consistent year over year always.
Yeah, absolutely.
So Matt, to sort of circle back, when you sort of were making this decision, I'd be curious to know, and if there are some things you can't share, no sweat. Did you consider multiple partners to work with? How did you sort of make that decision? What was the sort of timeline like? And what was it about sort of prop tech in particular that made you feel like this was the right person to do this with?
Yeah, it was a different SPAC that had originally reached out to us, and then we had several different conversations with and got educated about this mechanism. Because again, it wasn't even something that was on my radar. If you play this back, more than a year ago, 18 months ago almost, in terms of when we had that initial conversation, SPACs were not in the news. It wasn't something that as an entrepreneur and a CEO was really even in the consideration set, right? And so if you think about how much that has changed in a year and a half, it's just remarkable, to me, where, my board at that point in time as a private company wasn't even that familiar with the option, right? It wasn't something we were talking about. Now, every board for a late stage company, you're talking about it, it's in the consideration set. And so that is, to me, that's just remarkable, having been involved in this just massive change over that period of time. So really, it was a different SPAC that reached out to us, through a number of conversations. We just learned about the mechanics, the pros and the cons, just got better educated with our board. And then we actually started to figure, okay, who are the right SPACs? We got connected into property tech, which really was the ideal fit, both in terms of their strategic focus, them really seeing and being aligned, with what we're trying to build. And in the right size. You have to be able to, pair the right size SPAC with the right type and size company for the math to really make sense for all parties, involved. Like I mentioned before, once you find that right partner, though, there's a lot of different mechanisms and levers to be able to pull to get that deal done that makes sense, for all parties. And so it takes time, to take 6 weeks to kind of work through those conversations and figure out, how to structure the deal such that it makes sense for us and them and for the public markets. And we went out and you test the market with that pipe that Amy had talked about. We upsized from a $50 to $150 million pipe over the course of a week, dramatically oversubscribed. Wow. And then you pretty much know, right, that, okay, yep, it's holding, people are interested, and then you're off and running to just go and work toward the close. So it moves pretty quickly. Now, I will say for folks that are thinking about it, it's a lot of work. There's a tremendous amount of work on the legal and on the accounting side. There's a lot of staffing that has to happen within a company, particularly in the finance organization. So there's a lot that you have to go and start doing at that point in time. But it's the same type of work you do if you're taking the company
public. You have to do it anyway. You're just doing it faster, and hopefully
it just accelerates it and condenses it, really, at the end of the day.
Yeah. I would say what's going to be most differentiating going forward will be size. You mentioned, Mario, that kind of these large size deals versus smaller deals. As people say, it's always easier to make your SPAC bigger than it is to make it smaller. And if you think about late stage VC companies, there are a lot more that are kind of in that $600 million to $2.5 billion valuation range than there are the ones that are multiple billions of dollars that work for the Ackman, for the Ackman SPAC. So once again, you have this money in trust. It's not going anywhere. It's safe for the shareholders. And it's really kind of time value of it sitting there. But I personally believe there's a lot more flexibility for the SPAC and also for the target when you have a more reasonably sized deal or a reasonably sized SPAC. The economics aren't as attractive for the sponsors when it's a smaller size deal, but it's probably the right way to do it.
Yeah, I agree.
I think that gets to an interesting point, which we, have sort of maybe not touched on as explicitly, which is, SPACs have clear advantages for founders. They have some clear advantages right now for the sponsors. For the average investor, like, how do you guys think about someone investing in SPACs? And in particular, I think this will be something that Amy has thoughts on. SPACs obviously go through sort of a fair amount of dilution by the time they are de-SPACed, which is something that maybe goes a little bit overlooked. How can we sort of look at the opportunity today and where there may be some places where we can improve upon it?
Well, first, let me just chime in. There's a few different types of investors, right? There's the initial investors that have invested, with a SPAC like Amy's very early on. There are, investors that start to get involved in that pipe, that are still early. And then obviously there's the transition into, ideally more, longer term fundamentals, more anchor investors, as you de-SPAC and as you go public. I think that one thing that SPACs that have performed the best do well, something we really tried to focus on was early in that process, get out ahead of that de-SPAC, really build awareness, build interest, build education with the right types of investors and shareholders, so that we were able to transition, to folks that are going to hold and understand the story and want to, be a part of this journey. Getting out ahead of that, it takes, again, it's a lot of time, but getting out ahead of that, really can be very impactful to how the business performs. But for investors, these can be tremendous, investments. Pipe investors for us have, an 80+% return in less than a year, right, on their investment. And we feel like at Porch,
you're bragging. That's really good.
I know, that's good. Great for them. Great. I mean, it's great. It's a home run, play for them. And you're able to get into these companies that are a bit earlier stage companies that, we feel like we're just getting started, right? And so you're get introduced. You have, information advantages that you're able to use to make really good investments at the end of the day, because there is a gap out there. Lots of investors aren't aware of these companies, and so those investors that are willing to do the work early, you can create advantages, for yourself. Yeah, go ahead, Amy.
I mean, kudos for you for creating that kind of return. And that goes to all the work that you and your teammates and your company does. So good for you, and that's great. That's great to hear, and that's the way that it should be. I'm conscious of the fact, we're 1 minute to wanting to go to Q&A, and I'm also conscious we're 11 minutes to cocktail. This is probably a longer conversation, but I actually think it's part of the democratization of early stage investment to individual and high net worth investors. With SPAC trust trading at, $10 per share, this is a chance to invest in a SPAC management that is going to find a high growth company that you are going to get in at $10 a share, where you otherwise wouldn't be able to maybe get into that private equity fund or that late stage VC fund. And so I think about it as individuals, democratization of venture investing. Think about it, the pipe is more institutional. We haven't really figured out a way for individuals to partner in that pipe, as well as just, public investors. Into the dilution, for the most part, the sponsor takes 20% of the SPAC, and that's part of the dilution, regardless of whether there's a warrant or not.
So talking about the warrant part of it, I would love to learn more about what you're doing on that front, Amy, and then maybe we can sort of step into the world of SPAC 2.0 and all the things that might come out of it. And of course, if folks have questions, now is a good time to bring them up, and we'll make sure to make room for those too.
So traditionally, SPACs have had warrants attached to them, both private and public warrants. I guess it was towards the end of March or April, the SEC said, wait, we want to look at warrants a little bit more. We're not sure that the accounting is being done correctly. Should they be accounted for as a liability or as an asset? And traditionally, they've been accounted for as an asset. I think the market was waiting for the SEC to come out with a determination of what should be done. And just so you know, the auditors, traditional auditors who really don't work in the world of SPACs were like, hey, it's not for the SEC to solve, it's for the auditors to solve. And that was my indication that it was going to probably be a 4 to 6 month process for all of the accounting to get worked out, for companies that are trying to close mergers to work through their accounting before people that were already in the backlog could get out. And that was part of the reason why we chose a non-warrant structure and an alternative. And I think part of that move towards, regulation of questioning accounting, questioning how many forward-looking statements can you do or how far out can you go, will create innovation, because the structure of SPACs are here, but how you do it, those dials that Matt was talking about and those levers that you can pull, I do think that we have to get more innovative.
All right. Well, I think we have a question from the audience. So thanks to whoever posed it. The question is, do SPACs speak to a longer term trend of financial engineers being replaced by operators? Matt, curious if you have a take on that.
Yeah, I think, there's a place for both, certainly. I think the financial engineers are often out in front, figuring out how to create the next mechanism and innovate in some of the financial, tactics and tools that can be used. In some ways, I think some of the things, Amy, you're doing are really, new and innovative, and I think that and some of those will come from financial engineering, and really the whole SPAC ecosystem, originated from people doing kind of, unique and creative ways to be able to structure, this financial tool to be able to produce value, for all parties involved. But like we talked about before, there is now that financial engineering has become well understood, and the mechanisms are available to everybody, right? And you can crossed over to just general awareness of how it works, because it is a bit complex. But once there is that awareness, well, yeah, now your financial owners could be challenged a bit, because if companies, like a Porch is, debating on who you want to go public with, clearly you're going to choose those that are going to help you operate, the business most effectively and going to add the most value at the end of the day. I do think there's again room for both. I think the financial engineers will start getting out in front and figuring out the next set of tactics and things to use to be able to, differentiate. And I would expect operators to kind of lag behind there but to be competitive, because at the end of the day, they're going to be able to help add value to the core business.
I remember when I was an equity research analyst covering financial services, and I was trying to understand the economics of different types of transactions. And I was sitting with the CEO and I said, okay, help me understand, why do you get 50 basis points for a fixed, a high grade, investment grade fixed income transaction, and you get 7%, those are the days, for an IPO. And he said, it's very easy. It's a less educated buyer for an IPO, because you often only go through it once, right? So if you kind of think about where are the places that you are traditionally the least experienced or least educated, whether it's when you go public for the first time, whether it's a health scare, whether there's some other personal issues, you don't do it enough. And so as people get more educated, just like VCs and private equity firms have gotten more educated and pushed down pricing in the IPO market, I think you're going to see some of the same thing in the SPAC market. And
so, Amy, if I'm right, you are on the board of one SPAC and then just recently sort of worked on this other one. Is that right?
Correct. So I'm on the board of Tuscan Holdings, which launched in 2019, and I thought it would be an interesting way to learn how another way for a company to go public, because I like taking companies public. And they have announced their merger with Microvast. So originally it was supposed to be a focus in the cannabis space. Cannabis valuations fell sharply, and we have an announced deal with Microvast, which the proxy is outstanding for hopefully closing in July. And then, yes, last week, IronSpark 1 went public.
Got it.
And
awesome.
I'm chair of that. I'm on the operating team.
And so what I'm fascinated by is, you've had what I would say is a quite remarkable career. You're now spending your time thinking through SPACs. Is that something that you think you'll spend sort of the next few years sort of playing with these different boundaries and trying to turn this into a new vehicle, even from where it is today? What is it about it that is so enticing to you?
Well, I have at least 24 months. It could be less, right? Because that's the time frame for this SPAC. Look, I'm not only just a student of financial services, but I'm a little bit of a junkie for change and innovation. And whether it was the change that we created at the New York Stock Exchange, whether it's kind of the innovation coming with the long-term stock exchange that I'm affiliated with, whether it's introducing, new structures in the world of SPAC, I think that's what's interesting to me. And how do you move this ball forward? And maybe this is a good way to end, the financial services section, but this is an ever-changing, fascinating industry. And when you have the opportunity to really make an impact and move that ball forward on innovation, which doesn't come that frequently in our world, right? There's a lot going on, but true innovation is rare. And so that's what I really enjoy doing.
Amazing. Well, I think that is a very good place to end, and 2 minutes early so that people can get to their drinks, a little bit faster. So with that, I will say thank you very, very much. I'm going to pass the ball over to Matthew, and it was awesome being with you both here. So over to Matthew Gardner.
Thank you.
Thanks.
Thank you, Mario. Thank you, Amy. Thank you, Matt.